A lot of business owners are really good at making money, but when it comes to leveraging it for financing to either help grow their business or to buy property, they have no idea where to start. Now, I'm not a broker or a finance expert. I've been an accountant for the last 17 years and I run an award-winning accounting firm called Box Advisory Services. But I do work with a lot of brokers and I know a lot about how to prepare your business for financing and what numbers the lenders are looking for. In fact, I've recently held a private consulting session for my clients about financing for small business owners, which I'm sharing with you in this video. This deep dive covers understanding your borrowing power and ways to improve it, key factors and metrics to consider, financing strategies and pitfalls, as well as detailed case studies. Now, before we get into it, you need to understand that this video is general in nature and is not to be taken as financial or tax advice. Make sure you seek professional advice tailored to your personal circumstances. So let's get into it. I want to just go over quickly what the definition of leverage and finance is. Basically, it refers to borrowing money. You can borrow money for your properties that you have, which could be investments or your home, but you can also borrow money for your business. So there are a lot of cases where you can borrow money for your business, but there are a lot of cases where you these days borrow money for property. And the reason why it's so important these days is because everyone sees property as a way of investing. Even the government sees it that way. And the reason why the government sees it that way is because the government can't build enough homes. And so they are encouraging investors to look at building homes, building property, investing in property. And so we can have enough property for, the general population that is growing so fast. That's where it's really important for you to be able to understand how the numbers work for you to be able to borrow the money that you need. The Australian landscape in Australia, the lending is actually not that bad. It's very regulated, but also regulated in a way where we've got alternative banks, or the big four banks or the main banks, and also government-backed programs that also lend money to businesses and investors as well. The whole point of this is just to ensure that, the people spend money, people invest the money into property or into businesses, so we can just continuously grow as an economy. You got to understand that leveraging, borrowing money, can help you generate higher returns. And the whole point of borrowing money is not just for you for personal use, where you can buy a nice fancy car or you can buy a property that you can live in. But a lot of businesses look at borrowing money as a way to, pay 8%, 6% in interest and generate a return of 10, 15, or maybe even 20, 30% in returns per year. So when you figure out how your business runs and that you're generating a profit of 10, 20% in returns, then if you add more fuel to the fire at a cost of 6% or 8%, you know that you can, grow your business a lot more faster. And it's kind of like the way I see it is you're borrowing funds from the future profits that you're making. So instead of you waiting for the money to be made so you can reinvest back into your business, you can just borrow the future profits from the business by going to the bank to lend you that money and then reinvest it into the business now so you can speed up the process of growth. All right, so let's just talk about the different case studies. I want to first start off with case studies just to give you guys a broad understanding of how you can use finance. And I think when we talked about super, we used some case studies and clients you guys really enjoyed it. So I want to first start off with this case study here, which is a client borrowed to invest in property with business profits. So I had a business client that was generating quite good returns. I think they were generating was about 20%, 15 to 20% in net profits a year. Net profits. So obviously the business grew over time. So first year they made maybe 100K, and then the second year they made about 200K, and their revenue increased quite fast. So when I say 15-20%, I'm talking about the total revenue. That's what they made. So they obviously grew quite big over the years. And when they started growing quite big, they had the money sitting in the company bank account. So let's just say after the third year, they had 3 years of 100K and then 200K in the first and second year. And then the third year, that was still generating income. So they had about 300K in profits. They paid the taxes that they need, and they're left over with $300,000. Then the client decided, you know what, I want to buy my home. And I want to buy this home that luckily he found that was a deceased estate, which is basically an asset that used to be lived in by someone, but that person passed away, and so it was not lived in for many years. So basically, that home was trashed. No one could live in it. Like it was looked like a haunted house. And so he knew that he needed to spend cash to reinvest back into that property and renovate it. And he knew that the next year he would still be generating a good return from the business, probably about anywhere between 150K to 200K. So this is net profits of the business. And this is like cash he was sitting, cash at bank. So what he decided to do then is that he was going to use this money sitting in the company bank account to lend it over to himself, and then he can purchase the asset. So normally when you buy an asset, you can put in 20% deposit and borrow up to 80%. This guy here, however, borrowed 100%. So he had a special way of doing it where he got a personal guarantee from mum and dad, and he was able to borrow 100%. What he did was he wanted to unlock more value and more benefits from this property. And by doing that, he needed to spend 300K or 200K in cash to be able to afford the renovations on this property. So a property was purchased for 950K. Then he spent about 200K in renovations. So all up, he spent 1.15 in cost to purchase and renovate the property. Yeah. So the way, let me just hide this for you guys so it's easier. So he spent 1.15 to renovate and purchase the property. And as he did that, and he after a year of building the property, he then was able to do a revaluation on that property, and the revaluation number came out as 1.5 mil. So what he then did when he went to the banks and bank value, he then asked the bank to give him 80% a loan for that 1.5 mil. So initially he borrowed 100%, so his loan was at 1.15. And now he wanted to take 80% of that loan out. So he went and took that times 0.8, and he took some extra money out, which is an extra 50K. So that minus the initial amount that he put in, he got about 50K on top. 50K plus the construction cost of 200K. So he took out about 250K back out of the property. You guys may have heard this story before, some of you. And this story is my story. So I just wanted to let you guys know that what I did was I didn't spend a single cent to purchase this property. What I did was I actually borrowed the full amount and used my cash that I had to pay for renovations and construction. And maybe you could say I got a bit lucky, but once I improved the property value, I went back to the bank and borrowed the full 80%. And so I can get my parents off the personal guarantee. But one of the other reasons why was because I wanted to get that money back, because I had to pay that back to the company. So I took that, initially I had 300K in cash. I took the 200K of construction costs back out, as well as the 50K. And then I lent it back to the company. So this is something that I find that a lot of people don't think about, where you don't need to always reinvest back into the business. You can actually think about investing in your personal home or personal assets, or investments, passive investments that you want to do as well. You can, borrow funds from the business to be able to do this for a deposit, but also leverage using the bank to be able to look at investments as well. So as a result, this property now, you guys seen the maths and seen what's happening with the property market, is now probably worth like 1.7, 1.8 mil. This was like 4 years ago when that happened. And so let's just say like it's worth 1.6 mil now, just to be safe. And I actually think that's the value because the next door neighbor did a valuation on their property and it was 1.6 mil. So I initially really spent 1.15 and I was able to get about 500K capital growth on this property. Remember, this property is my home. I live in it right now. So if I ever sell this property, I've made about close to 400K in profits. With borrowing funds from the company, but I ended up paying the company back. So that's the keynote. I didn't really spend that much money at all. I just borrowed the funds from the company to be able to afford to do the renovations. I took a bit of risk because this property, I could have found a lot of problems with it and the renovations could have cost more. But I knew that at the area that I was trying to buy, it was a really great area. I knew the next door neighbor, which was my brother. And so I knew that if he lived there, this property probably is going to be very similar to his property. And so, I purchased the property without thinking. And I got very lucky, I have to say, because it was during COVID when that happened. Yeah, so that's like an example of being able to use finance to be able to supercharge your investments. So, however, I just want a keynote is I did take the money out of the business bank account. So that meant that the business was losing 300K at that point of time when I did it. So you need to make sure that the business can be able to afford to be able to run without that 300K sitting in the bank. Okay, so let's talk about the next example. Okay, so this is an unfortunate story. The client actually went bust after this. So the client financed a new truck and he started a new business. He was a courier company. So he used to courier around. I can't remember if it was a truck or a van. And what happened was that he purchased this truck, got contracts to be able to courier deliveries, and he was making good money. He used to be like working for his customer as an employee, and then he got this opportunity to be able to do contract work. So he bought the truck, and then he started he agreed on a price, and then he started contracting his services out to the customer. And before he knew it, he was like all his money was hitting the bank account of the business. Unfortunately, he wasn't really good in terms of going for help in terms of getting an accountant. He wasn't very responsive and didn't really do his bookkeeping that well. And so as a result, he just saw the money in his bank account that he was making, didn't pay any taxes, and then decided to purchase another truck. And he got both of the trucks on finance. And the biggest problem with this is that he didn't really do the numbers well, and he didn't realize that he wasn't using the first truck that he had at full capacity, and he wasn't making enough money. His pricing was wrong. He had a driver that was there. He wasn't paying the taxes for the driver. He wasn't paying the super, but he was paying wages. And so all the money that was sitting in the bank account of the business when he was generating the job generating services for that first truck, he thought he could use all that money because that money was profit. However, it didn't take into consideration taxes, didn't take into consideration all the expenses he needed to pay for, and he didn't take into consideration that he can't claim a full tax deduction on the loan repayments on the first truck. It's only the interest that he can claim. He can claim the depreciation and the interest, but there's still a lot of profit that he was making. And as a result, when he bought the second truck, it started now having cash flow issues because by the time he bought the second truck, it was year 2. He had to lodge his tax returns. He needed to get finance. So as you guys, most of you know, when you're trying to trying to go for finance, you need to actually produce tax returns and financials. And so you had to prepare your tax returns. We prepared all the tax returns and we advised him of the tax he needed to pay. He was like, yep, no problems. I'll make it on the second truck. So he went and bought the second truck without thinking too much into it. Didn't realize that he wasn't utilizing the first truck and the second truck at 100% capacity. And he also hired 2 employees and had to pay taxes for 2 employees. And the result is that he then had massive cash flow issues. Couldn't afford the repayments over time, had GST debt, income tax debt, wages tax debt. And as a result, he had to sell I think it was the first original truck or the second truck at a very major discount. And then the result is that, after 6 months of trying to make it work, he ended up going bust and he had to close the business down, and sell basically all his business, his trucks and assets. And it was a very unfortunate situation. We tried to help him and advise him, but yeah, he basically lost a lot of money as a result of that. Look, he ended up getting out of the business, which is good. We helped him liquidate the business and all. But yeah, that's the problem of financing way too early and not actually running your numbers really well. And the next thing is example 3. So this is also, I think, an unfortunate situation as well. The client wanted to minimize their tax. And this is actually quite common. Like before 30th of June, we have tax planning meetings with our clients. So April to all the way to June, we talk to our clients about their profit. And we go, here's your profit that we think you're going to be making for the whole year. And this is how much tax we think you're going to pay. So the client initially, let's just throw the numbers out there, was making about 100K in profits, paid themselves about $50,000 in wages because he wanted to lower the amount of taxes he wanted to pay. So at that time, before 30th of June, we said, your taxes is going to be about $30,000 for the year. He said to me, Davie, I don't want to pay any taxes. What can we do to reduce our taxes? And so I said, look, all right, you can purchase new equipment. This is back in 2022 and 2023. During those times, there was something called like the asset write-off that was like up to 150K, or there was no limit. So you can basically claim the whole vehicle or the whole purchase of an asset, the 100% of it on the first year that you purchased it. So what he did was he borrowed money from the banks, short-term loan, business loan, 3 to 5 years, and purchased a car, purchased equipment for his business, prepaid some expenses, basically cooked the books, but legally. He cleared all his profit, and then as a result, didn't need to pay any taxes. His tax was very low, and then 6 months later, he came back to me and he said, Davie, I want to buy a house. And I said, good luck, because I can't help you. And I told him initially during the meeting is that you got to understand when you try to minimize your taxes at the end of the financial year, spend all that money to minimize it and claim all those tax deductions, you're not going to really show a profit. And so when you go to the bank and try to go for finance, unfortunately, the banks would just go, your business isn't profitable. We can't lend you money when you don't actually make money. So as a result, the client had a bit of a struggle to be able to purchase property. And he has already spent the money, so there was not much we can do about it, and he couldn't go for the loan. So it's the reason why I'm explaining this example to you is because of the fact that I need our clients to understand that there's a double-edged sword when it comes to claiming tax deductions, and there's a reason for you all to always like plan for the future. And that's why when we do the tax planning, we always ask, what's your plan for the next 2 to 3 years? Are you planning to borrow funds? Are you planning to invest? Because if that's the case, you need to take money out of the company, you need to pay the taxes for it, and you need to be ready to be able to get the loan that you want. I will go through an example where we go through a profit and loss, and I'll explain what things that the banks will look out for. Okay, so the last example I have is option 4, where a client has been growing their business and renting their office. So they go to a third party, they have a landlord, and they rent their office. It's been about 2 to 3 years they've been renting, and they're pretty happy. Their business has been growing quite quick. Then they realize there's a commercial property down the street next door that's come up for sale. It's going for auction. They've got a bit of profit that they've made and decided, you know what? I think it's a good time to purchase this office. And the reason why they decided that is because instead of paying rent, why don't you just own the property? Interest rates at that time were quite cheap. So when I'm going to release a bit more information again, but when we realized that interest rates were 2% for, generally all over Australia, we felt like, wow, it's so cheap. Why do we even bother renting? Why don't we just pay interest instead? And so we decided that this property next door, we should buy it, even though the property was quite big. And as you can see now, this client is also Davie Mack. Yeah, so we decided to purchase this property that we're currently working in right now. And I have to admit, the interest rate has gone up and our rent has definitely gone up, but we've grown in size, and so therefore we could afford it. The great thing about this is now that, yes, this property is owned by us, and the
property value has increased. We have spent a lot of money to make an increase. We've renovated the property. We spent like $500,000 to renovate the property. However, the company pays for the rent. I don't specifically pay for the rent. And what I mean by that is the company pays me rent, and then I then use that rent to pay for the loans that I have and the interest. And technically, there's no profit that I'm making from this rental property, but the property does go up in value. And so, like, over time, and we haven't done a valuation on the property, but we've seen properties being sold, and we think that the property is worth like about 300K more now in the last 2 years. So yes, I've taken a bit of a risk, and yes, I put in some money to be able to borrow to buy this property. But if I were to do a valuation on a property, I probably will be able to again pull that money out of the business, and then pay myself back for the money that I invested. However, I'm going to leave it there because I think there's really good value of having a property. And so that's another example where you can actually use leverage to be able to borrow money to purchase a business asset that can help you grow your business. And now we've got, double the amount of employees and staff, and we have a place that we can keep growing and have more capacity to grow. The next thing that I really want to talk about is the key metrics and factors that you should consider when borrowing. All right. So when you borrow, I think it's really important for you guys to look at these key factors. One is the business stage. Where is the business at? A lot of businesses, the first thing they do is they try to borrow money straight away to be able to, purchase a business or start a business. And I think you got to be very careful if you're going to tread like that, especially when it comes to startups. When it comes to startups, 1 to 3 years, we don't actually know if this business is going to be successful. We don't know what the profit's going to be. So when you borrow money to be able to invest in this business, and you don't even know what the rate of return is going to be, that's, I think, as an accountant, very high risk. And I'm not like a financial expert. I'm not a financial advisor. But when you don't know what the rate of return is on a business, and you then go borrowing 8%, 10% interest on this loan to invest in this property, it's actually not a very good decision to make, especially when you don't actually know your numbers and you don't know if it's accurate, even if you have a guesstimate on what you think you're going to make. So especially when you don't have any experience in running a business. So that's why I think it's really important for you to understand where your business is at, how is it stable. And so, for example, like right now, my business, I have been running the business for 8 years now. We are generating about 15 to 20% in returns a year. And so if I really wanted to add more fuel to the fire, invest more money into the business and make it grow, and I needed $500,000 to do that, if I'm making a 15 to 20% return on my income, and I go and put 500K into business, all my goal is, if I put that 500K, I'm hoping that I can grow my business by $500,000 or maybe even $1 million by hiring more employees, spending more money on advertising, and then I'll still make that net profit of 15 to 20%. That means that 15 to 20% is more than what I'm paying in terms of my interest rate. My interest rate could be 8% to 10%. So technically, I'm making a 5 to 7% return on, even though I'm paying for the loan interest. So that's the difference when you're looking at your business stage and your stability of your business. You also need to understand the market conditions. Obviously, right now, there's a lot of talk about recession, a lot of talk about like the economy not doing so well. There might be a war that's going to happen. And so it's really important for you to consider that before you go and jump into it. Like, for example, gyms right now. There's F45 going downhill. There's a lot of gyms going bust. Is it a good idea to invest in gyms right now? Maybe some people might see it as a good idea because, only the good will survive. But, gyms might be something that you might want to get out of and not borrow money to be able to facilitate this. The main thing that I'm trying to get you guys to think about is that borrowing money is a good idea, but you also need to make sure that you're borrowing money for the right reasons. That's the main thing, the right reasons. And in order to make the right reasons it's what we talked about in the first few deep dives, which is like you need to know your numbers. Okay, so this goes down to the next factor that I was talking about, which is the ability to actually repay the loan. A lot of people just borrow the money and they don't think about, okay, well, if I'm going to borrow this money, it's very similar to the guy that owned the trucks, that he unfortunately didn't really look at if he actually can afford to be able to finance the truck and make the repayments. And it's a very similar situation with this one where you need to be able to afford to repay those loans. When I started my own business, I did have a credit card. I also had an overdraft, and I had all the credit available for me to run the business. But I left that credit as a just in case. I never really used it. But then when I knew that I was going to reinvest all my income and profits into paying for new employees for that next year, I just wanted to make sure that I will be able to repay the loan if I needed to access that loan that I was going to use. So I had I think it was like a $50,000 overdraft. I didn't end up using it, but I did get the 50K overdraft just to extend my ability to be able to survive if something was going to happen with the market conditions, and if things didn't go according to plan, and I lost half my clients. So again, like I said, it's very important to also consider the numbers. Is there going to be a potential return on your investment? And that's where having these case studies, and a lot of it is to do with property. The thing with property is there's past data to be able to show what the last 10 years or last 20 years has been going for property. So when I throw these numbers that property value has increased 15% or 10% per year, it's proven that it's happened. With business, you don't have that data. So be very careful what you're planning to do. When you especially just started a business, that's the data is not accurate. So you might need to keep your business running for multiple periods, a year or 2 years, until you get accurate data before you make a decision on what your return on investment is. And that's why it's actually very easy to go to the bank, and then when you're buying a business, you have the financials from the previous or from the seller, sorry. You can actually use those financials to go get a loan from the bank, because the bank can trust that this business has been around and the potential return on investment is the profit that it's generating in the last 5 years. So it's really important to, take that in consideration when it comes to, going for finance. One last thing is the taxes to pay on the profits to service the loan. Very similar to that mistake that truck driver, business owner, did, was that he didn't think about the taxes that he was taking out of his business, the taxes that he needs to pay when he shows profit or generates all this profit. A lot of problems with this is that when someone generates a profit, let's just say this company here, this is a profit and loss that we have, and this business made $300,000, $334,000 in total income. All right. And then after all its expenses, including its wages, it had $120,000 in profit. If that person then took the 130K, put down a deposit for a property, what happens is they didn't take in consideration that the tax needs to be paid for this income tax. So usually people make decisions when the tax return hasn't been lodged yet. So they haven't even thought about how much tax they need to pay on this profit that they've made. Okay, so it's very easy to say now because I've generated the profit and loss. But when you make decisions on your buying property or investing and getting loans, you don't actually have access to these numbers straight away sometimes. Okay, you have to get this off your accountant. And so that's why we always try to encourage people to actually know their numbers, do their bookkeeping themselves. But the whole point of that is to actually know how much tax you need to pay. And so you don't go spending the full 130K. You take that minus the 25% first, which is the $32,000. And then now that you probably can only use 97K. Okay, if you want to take that money out of the company, it might even cost you more in taxes, because the tax of taking that money out of the company, if you're on the highest income tax rate, might be 47%. So you might only be left with $70,000 after really paying this tax. So a lot of people don't take that in consideration. And that's the part that's really scary. So they go and purchase an asset for 130K, buy maybe a a car, a nice fancy car, because they see this profit sitting here, and then take that money out, and then when they lodge the tax return a year later, because it takes 6 months to 12 months to lodge your tax return after the financial year, well, 6 months usually, to lodge it, because your due date is 15th of May the next year. You haven't taken consideration all this tax you need to pay, but you may have just spent the full 130K, and that's where you get cash flow issues. So it's really important for you to understand that. One last thing I want to go over is the borrowing capacity. Before I do that, I've noticed that there's some questions. So Sunny messaged and said, is there a conflict of interest in owning the commercial property that you run your business in? How do you navigate any concerns around arm's length dealings? So I'm not sure what you're referring to. Are you talking about SMSF? Because you're allowed to own a commercial property and run your business in it. Even if you own the property in your personal name, it's totally fine. Like, in the end, you're the one that owns it. And there's no regulation that or authority that is not allowing you to own the property that you run your business in. If I had other business partners, currently I don't, but if I did have other business partners that own this business and I own 100% of the property, there just needs to be a lease agreement, and it needs to be market rent, and sign that, make sure that there's like a deposit, keep it all arm's length. Totally fine. But technically, you don't even need to keep it arm's length. The only reason why I'm keeping it arm's length is so my other business partners get a fair deal. But being me, I'll probably be easy on the business anyway. So if things aren't doing well, then I'll probably reduce the rent to help out the business. It's actually better to be actually own the commercial property that you're renting. So you can do all these investments in this property, and you know that this is investment that would help the landlord as well as help you, which you are the landlord. So you can go back to the bank and then borrow more funds, because being the landlord and owning the property, if there's no actual tenant in the property, you can't get a loan for it because there's no serviceability. So that's why having a tenant, which could be your business that pays rent, can be able to help you get leverage and get a loan and refinance money that you've taken out of the you've paid for that commercial property. Okay, so the next question is Jeffrey. Jeffrey said that, do you think it's a good idea to keep an overdraft line active for just in case situations? Yeah, 100%. I've done that. I've recently got rid of my overdrafts, and the reason being is because I'm going for loans personally. So it actually does impact your borrowing capacity as a business. But when I was all focused on, and remember, it's all about business stages and your stability. But when my first years of running a business, I kept the overdraft. And the reason being is because I knew I wasn't going to go borrow money. I didn't need to borrow money for my own personal home. I was living at home, and I was working in my pink bedroom, or my brother's pink bedroom, as an office. So I didn't really need the borrowing capacity to be able to buy my home at that point of time. So I had an overdraft in the business for $50,000. That increased to $100,000 at one point. And the whole reason why I had that was just in case if something bad happens, or if there was an investment that I could invest in. For example, I could hire this employee because I knew that person was really good and I didn't have the funds for it. At least I had an overdraft to be able to cover it. Yep. So Jeffrey just added on, have you ever seen instances where a bank has been able to let someone refinance a property based on property's rental income alone? Yes, there are sometimes, like, you separate the trust. So if you purchase the asset in a trust, I've seen instances where they just look at the rental income, but I'm talking about like the rental income of that property must be big for it to be financed. Like, I had a client that purchased a property. It was a untenanted property. It was actually a pub in Queensland, and that pub didn't really have a tenant in there. So there was no tenant. It was a mess. It was unrenovated. It was can't be used, and so the bank gave it a very low value. And they had to first use their own personal wages and profits of the business to be able to fund the purchase of that property. Okay, they got a second tier lender to be able to give them that loan, and they went through hell for the next 6 to 12 months because the business went slowed down a lot. They had some family issues as well, and as a result, they couldn't really refinance that money, refinance it into a new loan. So were paying a very high interest rate as a result of that. And then once they finally, I'm talking about like literally, they would have went bankrupt if within that same month if they didn't get this tenant in. They signed a tenant, and they signed a tenant on like 250K rent. And from that 250K rent, because it's a big pub. It's like a actual pub with like 3 stories or something like that. So once they got that tenant in, they were able to get that 250K and then refinance the loan that they had in that trust that were holding that commercial property. So it's possible, definitely possible. But yeah, you're talking about a rental property that has high income to be able to do that. And it negated all the other expenses and loans in their personal names because they just looked at that trust and that entity on its own with that property. Can it service its own debt? And it's based on like you trying to find a property that has potential value. So you would see that the investments I've had, which is my first home, which was a deceased estate, no one was living in it, and like no one actually even wanted to live in it. And I remember when I was in the auction and I was talking to my girlfriend, yeah, my girlfriend at that point in time, but now wife. And I was saying, oh, wow, this place sucks. Like, I can see I forget what you call it, but the bricks that under the foundations are broken down at the bottom of the house. And I was talking so much crap about the house because the people that were walking through were really scared of the property. And we ended up buying the property because we knew that next door was the same situation and next door was fine. When we went to the auction and it was COVID, no one wanted to bid on that property because they thought it was crap. But ended up being a really good property for us. Still has problems, but yes, it was still a good property. All right. So I just want to talk about some key metrics that you need to think about. So when it comes to property, the banks normally do a 6 times annual income. So basically what I mean by that is, say you make $100,000, whether it's profit or your wages, they will probably give you a borrowing capacity of 600K. Okay, this is not accurate, but this is just like a rough indication of how much you can actually borrow. If you want to just do quick maths. But the best way to really know is just use the CommBank mortgage calculator. So if you just go into the CommBank mortgage calculator, click on this, you can basically go to borrowing calculator and then just whack it in. Whack in that you're buying a property and just do the maths yourself. You don't need to go and see a broker to be able to figure these things out. Like you can basically figure it out just by just whacking in the numbers yourself. So as you can see, this doesn't look right. But as you can see that like if you were to put in 100K income, you can borrow close to 600K, but in this case it's 527. Maybe they're a bit more conservative on the borrowing power calculator. This is more accurate. But you can usually borrow up to 600K. I think it's because the interest rates has risen quite a lot in the last 2 to 3 years that this is lowered a lot more. It's generally quite hard to get it if you are going with like the top 4 banks. So if you go to a second tier bank, maybe you'll be able to get up to the 600K that you're looking for. Yeah, so that's one thing, a formula that you should know of. So the whole point is your income needs to be higher. Okay, you either make more money or you look at your profit and loss before 30th of June and figure out how do I generate more income legally. So legally is the right thing you need to understand. So for example, let's look at this profit and loss here. Before 30th of June, you might realize that, okay, I need to show high amount of income because I want to buy a $1.2 million property. So if I want to buy a $1.2 million property, and I'll explain later, but for $1.2 million property, I can borrow 960K. So what I'm going to do is I need to figure out, you work backwards. So you go, all right, how much do I need to be able to borrow 960K? So divide that by, say, 5.5, say 6, just for argument's sake. So I need to show a profit of 160K. Okay, that 160K is not just this net profit, but it's also this and the wages that you pay to yourself. Say that I pay myself $80,000 a year. My total income is about 208K. So now if I go back into my borrowing power calculator, and how much was it that I said it was 200. So let's just say 205,000 for argument's sake. I can borrow $1 million. And as I mentioned, 960K is what I'm trying to borrow, okay, to be able to purchase that $1.2 million property because I'll have 20% deposit. Does that make sense, guys? Okay, that's you working backwards. Now, the next question is, how do you make that $208,000? That's the next step you need. Speak to an accountant, look at the numbers that you have. Maybe you're spending way too much money on things that you shouldn't be spending. Maybe before 30th of June, you know that you had to pay for insurance. You know that you had to pay for a software cost. So in this business, for example, knows that they're going to have to pay for software. And that software is 15 grand in June. They might just go, you know what? Let's delay that software purchase in June or May. Let's pay it in July. Let's pay it in August. So therefore, this goes down. If this goes down, this will go up. So that's the things that you can do as a business to be able to make sure that you have the best opportunity to be able to borrow the funds that you need to borrow. Okay. And a lot of people don't do this. A lot of people as a business and as an employee, they just go, here's my pay slips, here's my profit, and then show it to the bank without thinking that these numbers, you control these numbers. You control it because you run your business. So what you could do is just work your butt off from April to June, get more contracts and income, and maybe even bring forward some of the jobs that you have in July and August that you can try to invoice and do earlier. So if I, like, for example, we're working in the past, but in 2020, like July 2020 and then August 2020, which is the new financial year, I might have a job that this client might have a big job that they could do. And that job is 50 grand. Maybe he can take a phone call with that client and ask that client, hey, can we start the job earlier before 30th of June? What happens to the profit? It shoots up. So it went from 129 to now 180K. Okay, they are the things that you need to look at to be able to make decisions on being able to help you get the finance that you need. Okay, obviously you got to be careful. You can't just play with your numbers and just print this out into a spreadsheet and just, put $50,000 in. You actually need to plan for the year. You might even not plan this in April, May, or June. You might plan this even earlier, 6 months into the financial year, going, all right, I need to make sure that I need to generate about $200K, $210,000 in profit. How am I going to generate that? That's something that to think about. One thing that you also need to understand is business loans. So I'll talk a lot about property, guys. And the reason being is because I think property is something that works coincide with business. You make your profit so you can buy your home, or you can invest in property. And it's proven that a lot of people talk about property all the time. And so that they always ask questions about property. So that's why I talk about property a lot. But yeah, you can also get loans for your business as well. And usually the banks, they value your business at 1 to 3 times annual revenue or net profit. So depending on like what type of industry you're in. Say that your business is in accounting, for example, and you make $1 million a year in terms of revenue, the business is valued at $1 million, right? So the banks usually would be able to at least give you a loan of $1 million. So it varies though. Like sometimes it's 3 times revenue, sometimes it's $1 million 1 times revenue. It just depends on what type of industry and what type of multiple they value your business at. So it's quite hard to tell, but generally there is a loan to value ratio for when you borrow money. So with residential properties, loan to value ratio is 80% and then 20% deposit. So what does that mean? Loan to value ratio is the amount borrowed compared to the value of the asset that you're purchasing. So if you purchase a property for $1 million, you can borrow 80% of that. So you can get an 800K loan, but you have to put in 20% cash. Why do you think that happens? The whole point of that is the banks they want to de-risk. They don't want to risk you going out of business and then they have to sell the property. They have to pay for legal fees. They have to sell it at a discount and they lose money because they've lent you a full 100%. right? So how do they de-risk that? They go and say that you're only allowed to borrow 80%, and then the 20% cash you're putting up, that will be sitting in equity in the property. So if something bad happens, they'll sell the property for 90% value or 95%, take that extra 15% to pay for all these legal costs, and so they don't lose out of money. And they can take their 80% that they have to offset that loan that they have. Yeah, so that's what loan to value ratio is. For commercial property or for business, the loan to value ratio is lower. It's 60 to 70%. So you need about 30 to 40%. Okay. Again, I'm just an accountant. I'm not a broker. I don't know much about finance. This is stuff that you can find online. I thought I'd just compile everything, show it to you guys. There is something called a lender's mortgage insurance. There are ways to increase the 80% to 90% to even 100%. Like I said before, I got a personal guarantee on a loan. For accountants and doctors, they can borrow up to 90%. And there's no lender's mortgage insurance, but it's just that you had to pay like insurance if you want to borrow more, which is not really that worth it to me. Business loans, the requirements vary depending on the LVR, but generally high LVR, meaning that if you want to borrow more, like 90%, means higher interest rate. So you're just paying more. So right now, let's just say the interest rate's at 6% for a property, like a residential home. If you end up putting down 10% deposit, most likely you're going to be on the high end of like the interest rates. So they will maybe give you an interest rate that's higher. If you want to lower your interest rate, then you just need to put down more of a bigger deposit. Okay, so that's the key metrics. Okay, so what things should you take in consideration when you have your own business? Like, let's just use this as an example. And we're working backwards, 2018, 19, and 20. This business here just started in 2018. They started, 17 to 18 financial year. So let's just say they started in July. Their profit that they made for the whole year was $70,000. So that's the net retained profits. They did pay themselves a wage of like close to 50K. So the overall income that person made, including the company as well as the wages, is about 115K. So that's the net profit. That's the total income, total net income. So the banks will look at this amount, and then they'll put this amount into the mortgage calculating amounts to see how much they can borrow. So, like for example, you'll put in 50,000 here to make up for the wages. Sorry, it should be 47, but I've just rounded it up. And then other income of whatever that amount here is, 68. Yeah, so you put 68,000 here. Okay. If you do that and you generally put in like whatever your billing expenses are, like this person can borrow up 600K. Okay, but I just want to give you guys some tips. So what does the lender look at? So the lender would look at this business and they'll look at like the stability of your income. So if this business has only been trading for 1 year, they'll be like, well, should we really rely on this income? Is this income is this income stable enough? So they might have a percentage. They might just take a percentage of this profit, and they may lower your overall net income because the stability of the income is not that stable because it's only been around for 12 months. So they might just decide in their own calculations, reduce this income by 20% and just take up 90K serviceability for your loan. Yeah. Just remember, when you're trying to go to a bank to get a loan, they look at three main things. Okay, first one, which is what everyone knows, is your serviceability, which is basically service. Sorry, man, I'm struggling with spelling right now. Someone help me. There you go, got it. Serviceability, which is your income or profit, income and profit. Okay, second one is the LVR, loan to value ratio, which is like the 20% deposit to reduce the risk for the bank. And the last one is your reputation, which is your credit rating. Okay, they're the main things that they look out for. All right, there are other things, but the main things that the banks will look for is the income to service the loan for the next 30 years, the loan to value ratio. They want you to put down a 20% deposit so they can de-risk. And the third thing is your reputation. Have you been to jail? Do you have a good credit file? Are you paying your debts off consistently? And if you are, then the banks are more likely to lend you if you have a tick of all three. If there's a bit of issues in this, they may give you a bit of leeway, but then that will increase the interest rate because it's higher risk for them. Okay. So when you look at your own situation and you're going for a loan beforehand, 6 months before the financial year ends, you need to start thinking about this. How do I make sure that you're going to be able to get these three rules for your lending? Okay, well, serviceability is very easy. It's all just based on your income, all right? If you can make more profits, then you can hit the serviceability. Loan to value ratio, it's different. Loan to value ratio is all about how much money you can get out of your business. So let me just hide this. So from 2018 to 2020, this person only made $68,000 in net profit. So if you were to take that money out of your bank account, we're talking about how much savings do you actually have? And so this person would only have $68,000 in savings. If they waited for the second year, they would have $250K worth of savings. Savings here because of the retained profits, but also maybe even some savings in their personal name if they didn't spend all their money. So it's very hard for you to say that this person would have savings in the first year because in 2018, it's only $50,000 of wages. You take out the taxes, there's really not that much to be able to survive on. But 80,000 might have 10K, but the overall savings this person might have is basically this amount here, 250K. So this 250K technically makes up your loan to value ratio, the 20% deposit you need. So when you think about it, if your income is the 179 plus this, which is 258, you've got a serviceability 258K in profit, overall income. Then you've got a 20% deposit of technically about 248. Obviously, you got to take into consideration tax. I haven't taken that situation. And the reputation is go get a credit rating check. And also just make sure you pay your debts, like if you're planning to go for a loan. So these are the tips that I want to relay over to you for you to understand how do you actually make sure that you plan yourself to buy that property. Don't just go to the bank and just show your pay slips. Actually understand what they're looking for, which is serviceability, loan to value ratio, and their credit rating, and see what you can do in the next year or 2 years to improve this. When I first went and made the money that I made, I knew that the first year there's no way I'm going to buy a property. And so I generated this profit. I even in the second year, which is, let's see, 2019, I also said to myself, I'm not going to be able to buy a property. I have the cash now, but I won't be able to buy it. It's only in the third year I decided to buy it. And as you guys we talked about in the previous deep dives, these numbers are kind of like a example that I've taken out of like my own experiences. So these here is kind of like rough numbers that we generated, right? And then we were able to make this much money. And then in 2020 is the time where we decided to buy a property. Remember how I mentioned to you, I had 300K. Yeah, after spending a bit of money, paying the taxes, I had 300K sitting in my bank account and that I borrowed from the company. And this is it. I guess the last thing is the strategies, the type of strategies. I think we kind of really went through the strategies. Invest in assets that generate income, or there's unlocked potential in those assets that you can generate income. So the investments I've had over my years, and like I'm saying, I'm not a guru. I don't even know much about investing. I'm not that good. I'm a good business owner, but I wouldn't say I'm the best investor. But the assets I invested in, I found ways to unlock potential. I looked at my home. It was not rented. It's unencumbered. I knew that if I renovated the property, I could increase the value because the property was not valued at a very high value when we bought it. So if I spent $200,000 onto the property, which no one would want to do because they had to pay for interest and then they won't generate any income and they were scared about the property, then I knew that I could unlock value on that. Sometimes like businesses also need to invest in like more income, and how they do that is through customer acquisitions. So sometimes they won't have the customers, and so they have to pay on advertising costs. A lot of e-commerce businesses do this. So they get a loan from Shopify. Shopify is a platform where they sell their products. Shopify can lend them money based on future income. So what they do is they borrow funds from Shopify, invest it in advertising, and then sell more products as a result. And so therefore, that is a strategy a lot of businesses do. Hiring and training staff is another reason why people borrow money. And then I think a very good strategy is using those lending products. And I didn't go into specifics about this because I'm not a lender, I'm not an expert in finance, but there is something called like an offset account where you can borrow up to $1 million, but not use that full amount of the $1 million and pay interest on it. You can have an offset account which offsets that $1 million. So you can put $500,000 in this offset account, which is savings. And then you don't pay interest on that $1 million loan you have. You pay interest on only $500K because that $500K offset account offsets that loan of $1 million. So you only pay interest of $500K. So there are strategies of being able to have that money sit there, and you could probably borrow that funds from your business as well. Refinancing unrealized capital gains. So this is, if you've watched my videos, I say that the biggest thing property investors do is that they don't sell their properties. What they do is they refinance their property and take that money out. The crazy thing about refinancing is that you don't actually sell the property, so you don't have to actually pay the tax on it. So let's just say that case study that we used here, that they purchased the property for $1.2 million after spending the renovations and all that stuff like that. Property value goes up to $1.6 million. There's $400K of unrealized gain. In order to access that cash, some people think that they need to sell this property, but you can go to the bank and then go to the bank and say, I want to borrow 1.6 million times 80%. So initially, say my loan was at, technically I can actually borrow 90% depending on what type of industry you're in. Because I'm in the accounting industry, I can borrow 90%. So I can technically take out an extra 200K. Does that make sense, guys? I can actually take out 240K, and I'll use that 240K for my personal spending or whatever. I can buy another asset with it. But the point is, I didn't sell this property. I didn't pay any taxes yet. The great thing is it's my home as well, so I don't need to pay taxes. But I can also now take that 240K. And what I did with that 240K was pay back the company. But you could do a lot more with it. So the last things I would leave with you is the things that you got to be careful with. Obviously, don't over leverage. Don't mismatch your finance types and timing of business needs. Like I said, don't go for a short-term loan or buying all these cars for the business when you're planning to go for a finance for your property. Because if you get the short-term loan and the short-term loan goes for 2 to 3 years, that really affects your borrowing capacity. It affects your income. It affects your ability to be able to borrow 6 times your revenue, because you've then now have to pay for the loan repayments on the car. Also, taking consideration market conditions. What's going to happen to interest rates? What's the thoughts of is interest rates going to go up or down? If you borrowed at 2% and you're at your maximum capacity of being able to afford anything else when you purchased 2 years ago, like when the interest rate was 2%, you must be suffering right now because you can't afford to be able to pay for loan repayments now because the interest rate has gone up to 6% now. Yeah. And the last things is what we talked about, which is be careful with the taxes, purchase your assets in the right structure, get your financial and tax advice and legal advice when needed. And that's it, guys. Hope this was useful for you all. And if you have any other questions, feel free to email me. But the whole point of this was not to be a finance broker. I am not a finance broker. The only thing I'm trying to do is just educate you all that there are things that brokers won't tell you because they can't change your numbers. They just get what your numbers are and then they provide it to the bank. They can give you some sort of advice. However, it's a bit too late now because the tax returns have been finished. Whereas we can actually get the tax returns to match what the brokers want. And if you have the meeting with the brokers early and you say in 6 to 12 months time you're planning to purchase, that's when you can look at your numbers, show them what you think it's going to be, and then see what you can do, work backwards to be able to produce the numbers that you need to be able to get the loans that you want. And that's the whole point of this conversation.